Good evening, I'm Richard Gonclaves. Welcome to Market Moves. Tonight, the latest on the AMP-AXA battle, why AXA is holding firm. M&A talk sparked once again over IAG. Is QBE really making a play? And we'll find out what the market's real value is. Roger Montgomery joins us now to tell us exactly what moved the markets. When we talk about what happened on the market today, shares were up. Why so?
Oh, look, really what's happening at the moment is there's enthusiasm about the prospects for a recovery in the Australian economy. Markets on a daily basis will move largely based on what's popular. There seems to be some switching going on out of financials and into resource companies and cyclical type businesses.
And why is that?
Oh, look, who knows, Richard? Really, it doesn't. For the normal investor, for the investor who's trying to make money in the market over a long period of time, you really shouldn't get caught up in what's changing hands on a daily basis or even a weekly or monthly basis. What you should look at is what are things worth, and take advantage of buying great businesses when people don't like them. So if it happens to be the case that financials are out of favour at the moment and they're not the flavour of the month, and those share prices for the banks, for example, drop below their intrinsic values, well, the idea is to take advantage of the things that are not liked. You can't buy what's popular and expect to do well. So by the time we talk about it, it's already happened, really. And so what we need to do is we need to say, well, what's out of favour but very good quality and what's being cast aside? Let's take advantage of the market's wallet rather than its wisdom. Okay,
let's talk about whether or not there is real market value at the moment. And we've got a chart coming up on screen right now, which Roger can explain what it all means. So run us through what this chart tells you.
Okay, this is there's two lines here. You can see that the very steeply declining and more volatile, I guess, line it represents the All Ordinaries Index, and the thicker line, which has more straight areas or horizontal areas, that's the valuation. So I've said this before to you. I value individual businesses, and when I take all those values and I aggregate them, what we get is the chart that you can see there, and that is the intrinsic value of the All Ordinaries Index. Now, what it tells you is that in March this year, and you can see when the market hit its lows, there was a substantial discount between the price and the value. The value was much higher than the price. So that it was obvious that the market was cheap at that time. What we've got now is the reverse. So we've got a situation where the market's actually expensive, but let me say this, the value of the market can actually rise. So as companies, if they improve their earnings and their economic performance, their return on equity goes up and their profits rise, then what we'll find is that value line, that valuation for the All Ordinaries Index, that will start to rise. And it might be that the stock market doesn't go down.
Right.
Just because I'm saying the value of the market is lower than the price doesn't mean I'm predicting that the price is going to fall. What I'm saying is, look, here's the value, and if you happen to be able to buy it below that, well, that's fantastic, and that's what we should wait for. But of course, you and I are talking about individual issues, so we're looking at individual companies.
When we're talking about we can't go stock specific just yet, but when we talk about sectors or themes in the market, and when we're looking at that chart, are there any parts of the market where the share price is below that true value?
So on an individual sector basis, which sectors are actually cheap compared to their intrinsic value? On an aggregate basis, none of them are. There are more companies in each sector that are expensive compared to their value than are cheap. There's a couple of companies that are cheap, but really we're talking about a number of companies I can hold in one hand.
Okay. We'll talk about those companies or some of those companies in the different sectors in a few moments' time, but let's focus on some of the stories of the day. First of all, I think we're going to go to the gold price, if we can bring that up, because gold hit another record today. So an ounce of gold currently trading at around about, that'll change, just give it a second, 1,139.45, and these are the major gold players right now, the gold stocks. Newcrest Mining up by 22 cents today, Sino Gold and Lihir also firmer, Panost and was down today, and St Barbara, I think it's still on a trading halt as it sorts through a few issues. Gold, another record. Why are we seeing this strength at the moment? Well,
it's all to do with the US dollar, and it's an interesting paradox that we have at the moment. The bond market in the United States, some argue, is in a bubble. Now, you don't go and buy the debt of another country unless you're very confident about that country. So you've got the bond market doing well, suggesting the globe is confident about the US economy, but at the same time you've got the gold price going up, which suggests they're very frightened about the US economy and they're very nervous about that. But in essence, the movements that we're seeing in gold in the short term relate to the US dollar. So as the US dollar continues to decline, gold is being bought as if you like, as a safe haven for that. And of course, you've constantly got speculative fervour in precious metals and most commodities, and that seems to be on the buy side at the moment.
Okay, I also want to talk about interest rates and get your take on it. More interest rate increases could be on the way if the Westpac Melbourne Institute leading index is any guide. The index of economic activity suggesting Australia is headed for a strong recovery, surging to 5.8% in September, up from 3.78% in August and a low of minus 5.4% in May. It's the fastest turnaround in the growth rate of the leading index since the economy bounced out of recession in the mid-1970s. Westpac says this adds to the case for a rate hike in December. That's what Westpac says. What's the market saying in terms of where interest rates are going?
Well, look, at the moment, if you look at the stock market doesn't seem to care that interest rates are going to go up, because the stock market, its current take about interest rates is that that indicates the economy is strong and therefore profits are going to rise for companies and therefore we're going to buy stocks. And so that seems to be the theme at the moment. But investing on that basis, so investing on those themes and on the expectations that the market will continue to look favourably upon rising interest rates is fraught with danger, because the market could turn around and say, OK, well, that's enough. Every time interest rates rise now, it's negative because the interest expense for companies is going up. The profits are going to go down. It's going to put a dampener on valuations as well, as it always does. I should say that when interest rates rise, it's the same as gravity. It's an invisible force. Gravity's an invisible force that keeps us on the ground. Yep. Well, interest rates going up acts like gravity on the valuation of assets, whether it's property or bonds or shares. It really doesn't make any difference, or even businesses and farms. The true values of those businesses decline when interest rates go up. So we just need to be careful that for values of the aggregate stock market to rise, we need the profits and the return on equity to rise more than the interest rates are rising. Otherwise, we'll get a net decline in values. But I'm not too worried about that at the moment. Okay. I've got a suspicion that Australia's the lucky country again, and we're going to see values for companies rise over the next few years.